Next is the units of production method. Okay, units of production method. This one is the calculation of the depreciation is based on the units of the product that you produce. So how you gonna calculate? Depreciation per unit will be cost minus residual value divided with total units of production. Okay, this is the depreciation per unit. And then the depreciation expense is the depreciation per unit or per product multiplied with the number of units that you produce in that period. Okay. So this is the illustration. We're going to use the same illustration. Assume that in 2011, you produce 7,000 units of shoes. Okay. So how much is the depreciation in 2011? Okay. First, calculate the depreciation per product, per shoe. So cost minus residual value, 9,000, and total units of production, 36,000. Meaning that the machine will be depreciated for $0.25 per shoe. Okay. This is per shoe, but at that year you produce 7,000 units. So you just multiply them together. Multiplied. Okay, so 0.25 multiply with 7,000, and then you get 1,750. So this is the depreciation expense. You use this number to record. Okay, to record, sorry. So you will record at the end of the year, you will record depreciation expense 1,750, and then on the credit side, accumulated depreciation expense, the accumulated depreciation machinery 1,750 at 31st of December. Okay. So this is the schedule of units of production depreciation method. So number of units, it can be like change, right? It's fluctuative. It depends on your productivity. And then depreciation per unit is the same, 0.25. And this is the depreciation expense, and then accumulated depreciation and carrying amount. Okay. But what you need to understand that for if you use the units of production, right? The depreciation expense is always dependent on your productivity. Okay, how much units that you will produce. So for this one, usually people use this type of method, will apply this method for production machine or for mineral sources. You will see this one later at the end of this chapter. Okay. Next one, the last method is double declining balance method. Okay, double declining. Okay. First, step 1, you calculate the rate for the straight line rate. So 100% divided with the useful life. In this example, the useful life is 5 years. So 100% divided with 5 years, then you get 20%. Okay. And then step 2, you double them. You double this rate. So 20% multiplied by 2, you got 40%. Okay. And then step 3, the double declining balance rate multiplied with the beginning period carrying amount. Okay. The beginning period carrying amount for 2011 is 10,000, right? So at the end of the 2011, you have to record 4,000 as the depreciation expense. Let's see the schedule of the double declining balance method from the year 0 until year 5. Okay, and the carrying amount is 10,000 at year 0, and then you copy them here. The depreciation rate 40%, you multiply them, you got 4,000, and then accumulated depreciation 4,000. The carrying amount will be 6,000, right? This one minus this one, and then the 6,000 you copy to here, and then 6,000, the what we call the ending balance at year 1 will be the beginning balance at year 2, right? That's why this one you copy to here, and then you multiply with 40%, then you get 2,400. Okay, so meaning that this number you will record until 31st of December 2011. You will record depreciation expense 4,000, and accumulated depreciation machine 4,000. But on 2012, at the end of 2012, you will record depreciation expense for depreciation expense, and then accumulated depreciation machinery for how much? For 2,400. You record for 2,400. Okay. So if you use double declining balance, the depreciation expense will be, firstly, it's very big, 4,000. But year by year, the depreciation expense becomes smaller. Okay. But the thing here, the unique thing in double declining balance that you need to pay attention is this number. Actually, if we calculate that number 1296 multiply with 40%, this is not 296 but 5, should be 518.4. But why we record 296 here? Because we want to make the carrying amount at the end of the year as 1,000. Okay, we want to make, we have to write this number first. This one 1296, right? And this one has to be 1,000. That's why 296 will be depreciated. So you just write here. You don't need to multiply this manually. You just write 296 here, so that here will be 9,000 and here will be 1,000. Okay, this for the double declining balance method, this is what you have to understand. This is what you have to remember when you calculate the depreciation expense at the final year of the machine. Okay. Okay, this is just a comparison for the depreciation method. This is straight line, units of production, and double declining. So for the straight line method, the depreciation expense is always the same from year 1 until final year. But for the units of production, it depends on your productivity. Okay, if you produce more, then the machine will be depreciated more or bigger. But if you use double declining balance method, your depreciation will be very high at year 1, but very small at final year. Okay, it depends on your purpose. But once you choose one method, you cannot change it anytime you want. You should be like consistent with the method. Okay. This is partial depreciation. Okay, sometimes, for example, in this case, you buy the machine at the beginning of October, and then at the end of the year, at the end of 2010, you have to record the depreciation expense, right? So from October to December, it is for 3 months. Okay, so you record 10,000. You calculate 10,000 minus 1,000 divided with 5 years. This is 1,800 per year, right? But you only use the machine for 3 months, so you will multiply with 3 months divided with the 12 months, and then you get 4,450. So you will record this one as the depreciation expense. Okay.